We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Michael Oliver from Momentum Structural Analysis. How are you today, Michael?
Hi, Tom. Good to be here. I'm doing well.
Excellent to have you. And, it was kind of dawning on me that it's been almost, I guess, a little bit over 2 years since we first spoke. And it's kind of crazy to think about that and the amount of stuff that we've covered since then. But it's always a pleasure to have you on. And I'm looking forward to kind of digging into some charts with you today. So, before we hit record here today, we were kind of talking about some of the volatility that we've seen over the past couple months. And, even especially the past couple of weeks here. And you were mentioning to me that, one of your commodity reports that we'll dig into a little bit later, you're saying that gold really didn't participate in that similar rally as those basket of commodities. So you were explaining the idea that gold really kind of front ran the rise that all of those other commodities had. So could you kind of explain that again?
Sure. Well, we all know that gold was a bear from 2011, late 2011 to late 2015. Gold dropped from 1900 plus to 1046 low trade. Low monthly close, I think 1054. That was in December of 2015. Okay, so the year ended on the lows. Mm-hmm. In February of 2016, MSA got bullish because annual momentum of gold broke out. Now, price turned up about a point. It was about 1160 when we got 1140 to 1160 price. We got bullish and haven't changed since. But commodities at that point had also collapsed into a low in 2015 and 16, but they stayed there. So while gold worked its way into a base, broke out of the base in 2020, and then had doubled in price by the summer of 2020 from its low in December 2015, gone from just above 1,000 to just above 2,000. Okay, commodities were still laying in the hole. So gold anticipated the commodity price inflation, because inflation is, everybody thinks inflation is when commodities go up. That's baloney. Inflation is when the money supply increases rapidly, the money unit is degrading in terms of its purchase. That's the inflation, monetary inflation. And monetary inflation goes into different markets at different times, depending on investor preference shifts. And from 2015 on, the preference was for stocks, for sure. And so the Fed got what they wanted from me, actually from the 2009 low. They went into QEs and so forth. They did every trick they could come up with. And primary inflation, monetary inflation, went into stock prices. So we've had the biggest stock bubble in history. But gold, instead of looking at, quote, commodity price inflation, saw the inflation that was already there in the stock prices and other paper assets. So it reflected that, the degradation in the money unit. Now, commodities made their low effectively. We had our buy signal in October of 2020. It's about the time we first met, I think. And commodities were still in the hole, but gold had already doubled. So when you try to fit the two together, don't do it. Mm-hmm. Gold is a leader. It anticipates monetary events and trends. And we think the commodity upturn is merely a reflection of, not a leadership factor as far as gold goes. And we think there's more to go in commodities. Now, they'll rotate in and out just like any sector. You'll have some stocks within a sector that beat other stocks within the commodity complex. And right now, we happen to think that the leaders, gold and silver, are about to reassert themselves out in front of the commodity complex again, without the commodity complex having to do much more than just stand still right now. It doesn't matter to gold. It's the monetary inflation issue. So that's what we see right now. And we think that asset managers, as evidenced by the performance of gold mining stocks, especially over the last 2-3 months, like, the GDX right now, popular ETF, is trading either side of 40. Mm-hmm. Well, back when the S&P was at its high at 4,800, it's now in the 4,400s. It's been down into the 4,100s. GDX went from 28 to 40, precise opposite of the stock market. and stronger than gold again, after having been weaker than gold for the last year and a half and during the corrective process. So anyway, that's an interesting place to be. We strongly suggest the gold miners is a forefront runner. But watch gold and silver because we think they're going to command leadership once again and outpower the commodity complex.
So, Michael, you sent me a couple of charts and stuff for today's interview, and feel free to ask me to put those up on the screen. But did you want to start with the call that you made for the commodity explosion, as you called it?
Yeah, that'd be an interesting report. It was in October of 2020. And we put a headline out that said, commodity explosion at hand. Now, at that point in time, the Bloomberg Commodity Index, you can see on the top chart, the price chart, was just above 70, okay? It's now, it's gone up to 100, it's almost doubled since then, okay. The reason we got bullish on the commodity complex then is because the long-term momentum charts we were looking at the chart below, for example, is a quarterly momentum oscillator, had already broken out in late 2020, and by October clearly had broken out. So we issued a report arguing that the commodity complex was going to explode, not go up, explode. Well, we got our wish. The technical dynamics of the Bloomberg plus most of the commodities within the complex, whether you're looking at grains or crude oil, we got bullish at 40, bullish in soybeans at $9, et cetera, et cetera. You could have thrown a dart at the commodities within the Bloomberg and almost hit a home run with every one of them because they all went up at once. So it wasn't a situation where, this market had a specific fundamental peculiar to it that drove it north, or we had a drought in the wheat belt, or something like it. It wasn't that. It was a monetary movement of money out of stocks, starting to come out of stocks anyway, and moving in a preferential area, commodities and commodity-related stocks. And now commodity-related stocks like oil stocks are extremely popular. We got very bullish back then in 2020, summer through fall, on fertilizer companies. They've more than tripled. What an unglamorous place to be. But it wasn't because of a peculiar situation with a given commodity market. It was an overall monetary shift of money into this beaten off the page category. Mm-hmm. Anyway, that was our headline. So,
yeah, and as we show here, this is what your
momentum. This is quarterly momentum here. Yeah,
mm-hmm. Yeah. This is really what your analysis specializes in. So, So is it because of this triple topping formation program, and as soon as it breaks out of that, that's where you made that call, right?
Yeah, no, so the price chart wasn't breaking out of anything then. In fact, back then at $73 on the top chart, you could see it was bumping up under prior lows. Mm-hmm. So that's a place to sell it, right? Okay, if you're a chartist, you say, it's bumping up under the prior lows, good place to distribute and sell it. Well, no, it blew right through because momentum had already blown through. Mm-hmm. So we focus on momentum primarily, and then secondarily we'll look at price. But usually when momentum speaks, price will follow, and it did. Mm-hmm. And now, of course, we have a different situation because we've had quite an explosion. So we have a slightly different analysis at the present time. But anyway, that's a.
So this is the Bloomberg Commodity Index back in 2020,
right?
And we'll go to today's chart for it, right here.
Yeah, that's the monthly price chart there. And that first little circle on the top chart is where we were at that point in time, or actually slightly below that. We showed quarterly momentum on the prior page. Here's also an annual momentum chart below this, which means we measure not in terms of where price is in relation to a 3-quarter moving average, but where it is in relation to what effectively is a 3-year moving average. So it's a longer term metric. Mm-hmm. But you can see there that in late 2020 as well, it was a downtrend that went back to 2008 that we broke out above. Mm-hmm. So quite naturally, you're going to explode. I mean, the commodity markets have been depressed into submerged underwater look at that chart since late 2016, it was under 80. Good grief, it was at 240 back in 2008 and 9. Mm-hmm. So you talk about depressed. It's not going to stay down there forever. So it was mainly an issue of when.
So, Michael, when I was looking at this chart, prepping for today, I was trying to think about, let's say, some of the reasons associated with that precipitous drop from 2008. So is that mostly due to, let's say, the demand destruction around everything in that commodities index because of the crash of the housing market?
Well, it's a downturn in the economy globally during that 2009 collapse. And commodities tried to recover from the 2009 low, coincident with where the S&P bottomed in early 2009. That's where the big rally you could see 2009 through 11. But in 2011, commodities divorced themselves and from the S&P 500. So the flow of money back into asset categories, whether stocks or commodities, kept going for stocks, but not for commodities. And they entered a whole new wave of decline. Generally speaking, by the way, we're looking at annual momentum and price in relation to a 36-month average. When annual momentum changes trend, it usually stays changed in the new direction for a handful of years. In this case, you went from 2008-9 high to 2020, so a decade plus. So we've just turned up on annual momentum, a year and a half ago. Mm-hmm. Don't expect a bear market to come out of commodities anytime soon. Pullbacks, oh, sure. Mm-hmm. But you're not going to get a bear market. And also look at the annual momentum chart. It just blew the top off of every reading that it's had for 20 plus years. That's how strong it is, meaning its momentum is super strong. Mm-hmm. Yes, you could have a pullback. In fact, we've got a dual set of red lines on that chart. You come through at about 35 to 40% over the 36-month average, which is the zero line on that chart. So if we ever get a pullback down to that level, you're probably going to get good support for the Bloomberg. Now, that level for the Bloomberg right now, let's say next month, translates to about 118. Bloomberg right now is trading 130. Mm-hmm. Okay, so you could get a 10-point pullback. Not a big deal. Not that it has to pull back there, but if you did, that's probably where support is. But this is just the beginning of a multi-year uptrend in commodities. So the Fed dreaming on about how they're going to break commodities with their policy shift, dream on. What they're going to break is their stock bubble and their muni bubble and their high-yield corporate debt markets, which are in precipitous decline right now, by the way. Far more obvious than what's going on in the stock market. So money is flowing out of those categories that money favored between 2009 and late 2021, last year when the S&P made its high, and it moved into commodities, a cheap asset category. Mm-hmm. And we don't think it's something that's going to end soon. You could get a correction at any time, but it's a correction.
So based on this momentum chart that we're seeing here, obviously, let's say if your momentum is up around these levels, that's not necessarily a good entry point. But if it pulls back to either of the red lines, you're saying that'll act as support and maybe a decent place to get in for the next leg up.
Yeah. This is a point where, the optimal time to get into an asset category is when the risk is low and the reward is high, mm-hmm. and it's only just breaking out. Well, that occurred in October 2020. Right. And there were some other secondary points on the way up. But right now, as far as the broad commodity complex is concerned, looking at the Bloomberg, for example, it's not an optimal entry point. If you pull back 7, 8, 9% or something, then maybe you could talk about lower risk. But it's a secondary entry point. It's not a primary one. So mm-hmm. It's not a place to put all your money all at once. It's certainly not be highly leveraged. Mm-hmm. It's more of a time to look for breaks and put on unleveraged positions, like, outright long certain commodity stocks or certain commodities ETFs that are not leveraged and so forth. Here's crude oil. Now, obviously, it was a major contributor to the Bloomberg commodity explosion, but most commodities had a big up move. But it broke out by our metrics at the first circle, which is, and by the way, also on quarterly momentum, which we don't show here, just above $40, quarterly momentum broke out, and on annual up around $40 to $50 area, that circled zone on both charts is where the annual momentum first broke out. And then later, early this year, it broke out above a shelf of highs on momentum. That's a secondary breakout. And sure enough, after that, we went from $80 to $90 crude to $130. Mm-hmm. Now, there was an excuse. We all know the excuse. But that's not the factor that drove crude oil up from $40. Ukraine wasn't an issue back in late 2020. Okay. It was an issue late last year, early this year. So it was a late news factor. So chasing a piece of news like that is kind of spooky. We suspect that crude oil recently had a drop, by the way, to $92 this month after having seen 130 last month. So you had a pretty big drop there already. And we suspect if you look at the momentum chart there below, you'll see this month's low pull back to the top red line. So basically that low this month at 92 was approaching what we consider to be a general area of support for crude. Let's call it either side of $90, okay? So it's not so risky here, but we could envision a situation where what crude does is, also notice this other feature. You see the annual momentum peak there at 130 that occurred, last month at 130. Look at the left side. You'll see it also peaked at $70 over its zero line back in 2008. That's when crude was up above 140. So momentum has had a dual peak there. Now, don't expect it to collapse because this is a fresh breakout. It just broke out over a multi-year ceiling. But you could easily get a volatile range here where crude flip-flops in a $40 range in price, let's say from 90 up to 130 or even more. Maybe test the 140 high again. But it could get volatile. And so it's kind of spooky to establish a position here unless you put one on, let's say, down near 90.
Or you're watching it very carefully.
Yeah,
right?
Watch it carefully. But you could get a violent trading situation. And frankly, from the point of view of the world economy, it's not an issue whether gasoline prices pull back 10 or 15 cents per gallon. Who cares? They touted that the other day. I think Biden did. It's whether you really turn down, and you're not going to. Oil's going to flip-flop at worst up here in a range, in a high-priced range, a higher price range than we've seen in 10 years or so. So it's a choke-off type price level. It'll have a negative economic effect in terms of energy costs for corporations, for individuals, et cetera. So don't expect it to collapse. It could get volatile. There is a market, though, within the energy sector that we tend to favor right now, and that's natural gas. As you can see, this is through about a week ago, these charts. So it's gone actually higher since then. It tagged $8 on natural gas. But look at the price chart, just for example. As commodities collapsed from their 2008-9 high, natural gas was up around 14 at that point. It collapsed down to $2 and ultimately got down in late 2020. It's coincident with oil dropping down to $10 or something. Natural gas got down under $2, like $1.50. Never been that low in decades. And then in the surge that occurred last summer, August and September, it broke through a parallel price channel on the price chart. It's marked by high closes and low closes on the price chart. That broke out, and it was a statement surge, we called it, meaning it said something. It says, I'm back. Okay, I'm different than those other rallies that you see to the left there. I'm not just going to go up and collapse again. This time I'm going up, I'm going to stay up. But pull back into early this year, late last year, and then reasserted itself again on price. So in fact, we were correct in assuming that was a statement breakout by price last August and through October of last year. Again, that breakout occurred what? Well before Ukraine ever became a headline. Okay, so it wasn't based on natural gas going from Russia to Europe. Now look at annual momentum. It also broke out last August above all the closes on the lower red line that had occurred going back all the way to 2007. All the monthly oscillator closing readings, it cleared those. And it ran up in October last year and matched the prior oscillator high that occurred in 2005, which is like at 140% over the 36-month average. Well, look at the price chart again. Where were we back in 2005? On the top chart, crude oil was approaching $16. Okay. So momentum has now said, I've blown through a dual peak on momentum and taken out even the oscillator high that occurred back then. Price has broken out and has reasserted itself. We think this is a fairly fresh situation, one that could see natural gas perhaps do what crude oil did. get up and approach those highs you see on the left. We think this surge could get you there.
And of course, this is domestic natural gas.
That's right.
What do we have to learn from the situation with European natural gas?
Well, the price spread differential is off the page. Mm-hmm. Their prices compared to ours, there's no comparison. It's like two different markets. And the reason is the logistics of getting natural gas here to there is different than shipping, let's say, crude oil or shipping wheat or something like that, where it's fairly easily shipped. Natural gas is a problematic thing to get from here to there. You have to compress it, put it on ships, only a certain number of ships, et cetera, et cetera. But there are factors that are tending to narrow that spread relationship. And instead of Europe dropping back, we strongly suspect the U.S. market is going to reassert itself up and narrow the spread difference. And there's also a big difference between, as we pointed out, looking at crude, between natural gas prices and crude prices. And if natural gas were holding the same, let's say, ratio relationship to oil that it did back in 2007, 8, and 9, heck, crude oil will be up around $12 or so, just narrowing the spread difference to where it was then. Mm-hmm. So we think that's another driving factor is that the cost of this as an energy source versus oil, this is a lot cheaper, and it's likely to narrow. And the technicals are telling us that. Mm-hmm. They're telling us you had a breakout last summer, you cooled off. Now you've just reasserted yourself with a fresh annual momentum breakout. So I would say that right now natural gas is trading either side of $7. It's backed off $1 from the recent surge high. It's likely to be a fairly low risk entry point. You don't have to use futures; they're leveraged. They can be leveraged, but the UNG, for example, is a very liquid ETF of natural gas. Reflects the front month contract. It's not leveraged, and it's trading I think about $24 right now. It wouldn't shock me if it got into the 40s. So anyway, this is one commodity within the commodity complex that looks like it's overdue to sort of catch up, mm-hmm. and has the more bang for the buck and less risk in our view.
And I think the next one we're going to talk about has even more of those characteristics, right?
Yep. Here's it's an essential food commodity, not like everybody who's healthy eats sugar, but it in fact is embedded in almost all the products on your grocery shelf. So, but anyway, you can see here that sugar had a nice move up. That first circle shows where it was in late 2020 when we said commodity explosion, around 14 cents a pound. Well, it shot up to 20 something, nice move, but didn't even get back to the top end of its basing pattern on the price chart, which is pretty clear. It says you've been up to 24 twice there. There's a red line connecting two rally highs. And we're congested now either side of 20 cents. Look at the annual momentum chart. It broke out over a good downtrend line back in late 2020, and it ran up to what? The top end of its comparable basing pattern. At price match that had been up to 24, but momentum has hit that level just above the 50% level, meaning price at each of those three peaks was about 50% plus above the current 36-month moving average. That's how we create the oscillator. So momentum now has a secondary breakout level noted by the second circle there. You get up above that red line on momentum, and sugar, we argue, is going to take off. And it's going to do something that nobody's even looking at. Nobody's talking about sugar right now. We like that. But that is a major momentum base. That thing is 10 years wide plus. And it's not at high levels. As you can see, we're talking 50% over the zero line. The prior highs were 100 to 120%. So there's plenty of room to run. What does it take to get above that red line now? Just above 22 cents. Now, if sugar went up to 22 cents, it still wouldn't be above the red line on the price chart. So the price guys wouldn't know there's a breakout underway. They'll only know when you get up above 24. So momentum, again, is leading here. So I would say if you want a commodity that has got a lot of oomph left in it, then if you get sugar up above 22, it's time to pay attention because it could throw a tantrum at that point on the upside. So this is one we tend to favor now on a risk-reward basis.
So of course we talked about gold, and you were explaining to me before this that silver has really kind of been the laggard. So what's it going to take for this, this other monetary metal to wake up, as you put it?
Well, as far as our work is concerned, it woke up in the summer of 2020 just above $19. And shortly after that, it went up to 30 within about 6 weeks. That's a weekly price chart on the top. So we ran our buy signal was based on annual momentum, meaning against a 3-year average. Now, this is even a longer term metric because we're measuring here against a 200-week average, not a 200-day, 200-week, which is what? It's equivalent to about 4 years. Okay. So even when you look at the 200-week oscillator, you can see that in that summer of 2020, it exploded through the ceiling that had developed around the 10% level. All during 2019 and early 2020. It blew that out and shot up to 65, almost 70% over the 200-week. That was a breakout surge. And after that, momentum cooled off. I mean, it was pretty hot. Okay, so it cooled off. It cooled off with price basically entering a trading range situation. Now, I drew a line on the price chart because actually about 6-7 weeks after price had hit its high in that summer of 2020, it dropped all the way back down and traded under 22. Mm-hmm. That was where that black line originates there. And then it popped back up to 30, and it was range bound, a big range, admittedly, $8 range. Okay. Mm-hmm. But then in 2021, and I think it was August or so, 2021, price went down and took out the September low that occurred in 2020, took out the black line. So now if you're looking at a price chart, you say, oh my gosh, silver's going to collapse, right? Okay. Somebody was bullish there. They didn't care that silver took out the price chart lows of 2020. So somebody said, I don't care, I'm buying it. Mm-hmm. So a lot of people think about the conspiracy control over silver and so forth. Well, somebody was underneath it buying it with resolution, and they weren't afraid by a price chart breaking through a prior low. Mm-hmm. Now, momentum all during that time on the bottom chart, these are weekly closes plotted in a relationship to that 200-week average. And you can see we went from like 68% over, and we zigzagged down for a year and a half. And finally, we made lows in late last year and early this year, where on top of the breakout level of 2020, all those 3 peaks that occurred just above 10%, well, we bottomed at about 11% over. Shot back up. Now, look at the red line on momentum. This is what we call a momentum structure. It was a pivotal low back at that September 2020 drop, and then it stayed above the red line until summer 2020 broke below it. And there are 3 rallies that rallied up to that red line mm-hmm. after breaking below it. Now, actually, this week, we traded up to about 26.49 on the May silver. Intra-week, we actually traded up to that red line again. But this line focuses on weekly closes. If you ever close a week out now, around 26.50, give or take, mm-hmm. You're going to break silver out above this structure, which should be another launch for silver. There was a similar chart to this we had back about 7 weeks ago based on quarterly momentum that had already broke out above. That was in the low $24 area. Since then, silver's been living mostly 25 to 26 area. So this is now a secondary breakout. So if you're not in silver, this is a closer up view of that situation there. This only goes back to 2019. You can see the corrective process in price, but then look, you can see more clearly that momentum chart. Mm-hmm. Each of those arrows point to a level that's 31%, give or take a decimal, above the 200-week average. So we have a structure that jumps off the page at you there. Mm-hmm. There is no such structure on the price chart at each of those peaks or lows. You don't see it on the price chart, but momentum says this is a major structure. If you clear it, you're going to go whoosh on the upside. Mm-hmm. And we think this secondary breakout over the 200-week, we already had our quarterly breakout, as I said, should rush you up to the highs and through the highs again. Mm-hmm. So if you're not in silver, or if you want to add to a silver position, our suggestion is if you get back up to this week's price highs again, especially on a weekly close, just assume you're going to get a new kick to the upside in silver that we got like 6 weeks ago. You get to get another one. This one will take you through the highs. Mm-hmm. So at that point, silver has, over history, over the last 40 to 50 years, 4 times traded up to a price level that was at least over 3% of the price of gold at that time. One time it traded up to 4.5% of the price of gold, and there was another time it traded to 6.5%. But there are at least 4 times in 40 plus years where silver's been at a price level of more than 3% of the price of gold. Well, right now silver's at about 1.3% of the price of gold. If gold didn't go anywhere and silver went up to 3% of the price of gold, now it'd be $60. If gold goes up to about $8,000, by the way, why that number? 3 times before in the last 40 to 50 years, gold has had a bull market trend that's gone from a bear low to a bull high. It's constituted a 7 to 8-fold move in the price of gold. Mm-hmm. Our low is above 1,000. Multiply that times 8, it says 8,000. That would just be another one of these routine 7 to 8-fold moves in gold. Mm-hmm. We think it'll be more than that. We're not in a routine world anymore. But if gold ever went to 8,000 in the next phase of this bull trend, silver would be at $240 an ounce if it were merely at 3% again. Mm-hmm. And our measurements of the ratio between silver and gold on a technical basis, and we don't show that here, show that silver is now back into a positive trend versus gold. It has reasserted itself. So getting back up to 3% is merely further reassertion of its performance trend, which we think is now shifted back to positive.
So merely almost routine at this point, right?
Yeah, almost routine. Mm-hmm. So we think if there's a surprise ambush out there in the commodity sector, and it would be a psychological surprise even to gold and silver investors because they're so worn out over the last year and a half. Mm-hmm. And if you look at it, I mean, if you got long good back in 2020, early below $20, you're doing okay. Okay. Mm-hmm. Yeah. 25, you're up pretty good. But silver hasn't exploded like most commodities have because it had an explosion in 2020. Yeah. Went from $12 to $30 in a matter of several months. But this is a tight-fisted range. If you stand back and look at it from a distance over years, for example, you'll see that this congestion zone since summer of 2020 is fairly tight-fisted. Silver has not collapsed, but it's bored everybody to death. And the sense of silver becoming extremely volatile, like let's say crude did, or what Bitcoin did in 2021, went from $10,000 to 60,000, 9 months. Okay, don't be surprised that this market does that. Mm-hmm. So this is one of our 3 picks to focus in on.
Michael, when we're talking about the importance of weekly closes here, and I was looking at the gold chart the other day, or the gold price the other day, being at 1950, 1980, somewhere in there, and I was thinking about this relative level, and in some respects there doesn't seem to be a lot of excitement or energy in the gold space. Like the last time we hit, just over $2,000. So as a relative level, closing right around that $2,000 mark or just below it as a weekly close, how different should we be viewing that? Or should we be, thinking about it as a lot more exciting than a lot of people are actually seeing it as, and feeling somewhat, like you said, bored and dejected because of the idea that we should be so much higher, considering all the money printing that we've seen and all of these different factors that it should be higher, yet this relative level is actually extremely strong, right?
Yeah, it is. And we do look at price. I just created a $50 by 3 block reversal point and figure chart of gold for myself. Haven't published it yet. But if you go back through history, when gold peaks, it doesn't double pop. It peaks, drops, congests for a while maybe, and then collapses. This is like 2011. Mm-hmm. You hit 1900 plus, dropped into the 1500s, and then spent the next year and a quarter between mid 1500s and I think it was above 1560 and the high 1700s. Okay, Couldn't get back to that 1900. Try all you would. There were 2 or 3 major rallies, just couldn't get back there. It finally just said, oh, heck, and collapsed. But we were bearish and starting in January 2012. So it sat there and traded sideways till 2013 and finally just fell apart. But it did not go back to its high. Okay, now, this is generally true with its highs and its lows. For example, 2015 low was on a rounded basis, $1,050, okay? You had repeated pullbacks in late 2016 and summer of 2018 that drove gold back down into the mid to upper 1100s. You could never get back down to that 1,050 mark or even down to 1,100. You couldn't get back to the low. They tried a couple times. So that's another example of once you make your high or your low, you don't go back to it again. Okay, here's the story now. We made a high at 2,050 on a rounded basis, $50 increment. You posted some nice downticks on that point and figure chart, the circles, okay? Went all the way down to 1,700 during March of 2021. Shot back up to 1,900, pulled back down to about 1,750, shot back up to 1,900. You couldn't get back to the 2,050, nor could you get back to the low of March 2021. We traded to 2,050 again last month. Actually, you traded to 2,078, $8 above the actual price high of the summer of 2020. But on that point and figure chart, back to top tick. Okay. Now, point and figure people, unlike price chart watchers, don't mind downticks when they're looking to get bullish. Sometimes downticks are very bullish. So what did gold do? The Fed raised the rates, so gold sold off. People haven't learned the lesson that doesn't matter anymore to gold. Gold's $200 higher than it was when the Fed started talking about taper, okay? And dropped to 1,900 within 6 trading days of that high. Now, we don't have the charts here, but that put 3 downticks on that point and figure chart. So if you're a point and figure guy, what you have now is a double top at 2,050. You're salivating because if you put 3 upticks on that chart again and you touch 2,050 again, you're not going to stop. You're going to have a triple top breakout. So you're asking about the 2,000 level. That's probably important because you're touching top $100 tick again. But gold has already said, I've gone back to top tick. If this was a top, I shouldn't have done that. And by pulling back the 3 ticks, you've set it up as a double top, meaning a triple top pending breakout. So you ever touch 2,050 again, I would not wait for 2,100 because the point and figure guys are going to get very excited. That is a huge price chart launch point. Momentum's already spoken. It says, I'm ready to begin the trend again. I've had my corrective process, but that price chart is a stick of dynamite right now. So yeah, it's important what price does now. And I think if you see 2,050, you should be loaded up in gold stocks and loaded up in silver at that point. Gold is the mama, but those guys will do a little better, a lot better, in fact.
So you also mentioned the idea that the Fed had raised rates at that time and that gold didn't really care. And of course, again, before we hit record, you and I were discussing the US dollar and how the DXY isn't really a good index. So how do you see the dollar as affecting or acting as a headwind or tailwind for the gold price?
It's a tailwind at best. At the low close in gold, this is everybody remember this. The low close in gold was December 2015. Gold was 1,054, I think. Okay. At that point in time, the dollar index, which is not really an index, I'll get to that in a second, closed that month at 98.67. Okay. Dollar index right now is at 100. Okay. It's 1.5% or so above where price was when gold made its low in December 2015 and has since doubled. The dollar's gone sideways in a 12% wide range. And it's right now only a little more than 1% higher than it was 6 years ago. So anybody looking at the dollar for its influence on gold is wasting their time. Dollar's been asleep for 6 years in a very tight, narrow little range. It's tried to get back up to the top end of that range recently. But again, Momentum Structural Analysis, MSA, ceased to analyze dollar index a month or so ago. Instead, we're analyzing the dollar versus each currency, yen, euro, Canadian, Australian, et cetera. You get totally different pictures. The problem with the dollar index is it's 57.6% weighted by the euro. If I created an index of 20 tech stocks and one of them constituted 57.6% of the index, it's hardly an index. It's more an ETF of that stock, right? Okay. So think about that. There's better ways to measure the dollar. Yes, the euro has been weak recently for obvious reasons. They've not been as tight as the Fed has been on policy shift. And we've had the European situation with the Ukraine, and therefore a sense of upset in terms of the European currencies. So the euro, in terms of the euro. So the euro has dropped, not precipitously, it's dropped. Actually, the euro got down to a level this week that we think could be support level. And we're starting to see some upturn today and yesterday. It wouldn't surprise us, you maybe just saw the low in the pullback in the euro versus the dollar. But don't focus too much on the dollar index, because if you do, you're going to miss situations. For example, we're bullish on the Canadian and Australian dollar. Now, if we took the view that the dollar index is bullish, then we couldn't be long Canadian or Australian, yet we'd have missed money. Mm-hmm. So it's best to focus on the particular currency versus the dollar, not some heavily weighted index.
Mm-hmm. Yeah, I mean, that kind of speaks to the point that the U.S. dollar might be the cleanest dirty shirt in the bunch, and it's just a relative measurement of
one fiat currency versus another. Yeah,
mm-hmm. Yeah. There was somebody that had said it a different way of a bunch of free falling currencies that are only matched relative free fall to each other, right?
So another 4-letter piece of thing. Yeah, right. That's exactly right. They're all competing in terms of how much is our currency going to lose value in terms of real terms versus that currency. Mm-hmm. And we think that the events that are going on in the stock market right now should be watched, because as the stock market continues to top, and we think it has topped, and goes into an arduous bear market, which bear markets are, they never crash. Mm-hmm. 87 was not the beginning of a bear market. March of 2020 wasn't the start of a bear market. But if you go into an arduous bear market, the Fed is going to have to pay attention to an economic downturn, not just here, but globally. Mm-hmm. And I think they're aware of that.
So, Michael, you had mentioned as well the Australian and the Canadian dollars. What are some of the fundamental reasons for that? Is part of the idea that the amount of commodities that they have to export and the strength of their economies due to that can play a role there?
It's the commodity relationship, I think, entirely. Mm-hmm. They tend to reflect to some extent what the Bloomberg did. And yes, I think they're basically commodity currencies. Mm-hmm.
Excellent. Michael, is there any other points of interest that we should talk about today before we wrap up here?
Yeah. In the terms of the stock market, which we think is a precipitating factor for gold. Mm-hmm. In fact, if you'll look at when did the gold mining sector make its recent low? December. When did the S&P make its high? December. What did they do since? Opposite directions. Mm-hmm. So remember that. Same with gold. Went up while stocks went down. Now, stocks are trying to rally right now. What's gold doing? Pulling back. Okay. Mm-hmm.
So is that more of just they're
inverse related?
Yeah,
absolutely. And I think the reason is that the gold knows that if the markets that the Fed cares about, namely the stock market, the muni bond market, and the high yield corporate debt market, which are all those latter two in precipitous collapses right now, those markets mean something to the Fed in terms of maintaining this so-called new policy. Mm-hmm. You break those markets too much, they're going to have to think twice, or they're going to have a disaster on their hands. And I think they're aware of that. I actually think what they're doing, and it's been suggested by other people, that the Fed's trying to get rates up a bit so they can drop them again, because they can't drop them from where they were. So let's get them up to 2% so we can pull back again. So we have a policy tool. Gold knows that. And therefore, watch the NASDAQ 100. It made a low this past week within 90 points, NASDAQ 100, of hitting a trigger number for us that would indicate to us that we're going to blow out the March lows. The NASDAQ 100 dropped to 13,780, I think it was. And we've got a number of 13,690 that, had we touched it, would have indicated it's going to flush through the March lows, make new lows for the move. Mm-hmm. It missed it by 90 points, which for the NASDAQ 100 is trivial. the rally from that low tells us our number is right, because it means that the market sort of knew not to touch that number. If you go back down now again and take out this week's low next week, let's say, you're probably headed to take out the lows of the entire move. So they're trying to defend the stock market. The stock market is trying to defend itself at levels that don't show up on price. They do show up on momentum as levels that would indicate next leg down. And we flip that over, and it probably means next leg up for gold. So watch the stock market as an inverse.
So, Michael, when we think about the tools that the Fed has at this point, the move that we saw yesterday on Tuesday, the 19th, would it be possible that the PPT came in to help protect that number, as you just said it?
Well, I think they're out of tools because the market asset preference has occurred. It's shifted. Mm-hmm. Large fund managers who aren't gold bugs, the Ray Dalios of the world, have doubted and been skeptical about the bull market stocks. Too many parameters have been exceeded. Too much time has been spent. They're nervous. And they've begun to move assets into commodity-related categories, which are undervalued and performing quite well. And once that shift occurs, these guys aren't traders, They're not flipping coins every 2 weeks. When they make a decision to move 5% out of this market and move it into that, they're probably going to keep it there. Mm-hmm. And they may increase it as they get rewarded for their decision. So once we get into a global depression, and I think that's where we're headed, partly because of high commodity prices, choking off corporate profits and so forth, and hurting consumer spending, that once we get into those situations that become measurable by the Fed's month-to-month metrics, the stuff they like to talk about, they're going to have to shift policy again, and maybe they'll be back up at 2% at that point. But I don't think it's going to matter if they shift policy, no matter what tool they use, because once the investor class, and especially the asset managers, make that decision, they're not going to flip-flop a year later. They're in a trend. Mm-hmm. And I think the behavior of those markets is telling us that since June of last year, mid-June Fed meeting, when they announced they were going to begin to taper at some soon point, and now have done so and started to raise rates, what's continued to go up and what's gone down? Commodities have continued up, gold has continued up, stocks have gone down. So it's not, having the effect on commodities they thought it would have. It's having an effect on the asset categories they do not want to see go down. So they're going to be panicked. And our opinion is it wouldn't shock us in the next 3 or 4 years that we don't have a Fed anymore. That it's been 100 years, it hasn't worked, especially the last 50 years of boom-bust cycles, that many academicians are starting to realize, hey, this is a pattern, and it ain't working. Mm-hmm. And once this bubble comes unwound, the 12-year stock market bubble off the page, and demonstrates that it's not going to stop coming unwound, and the Fed is ammunitionless free, they don't have any more ammo, dropping rates from 2 to 0 again ain't going to help. That's when real panic sets in. And doubt then among academicians and even politicians possibly about the viability of a central bank. Maybe we should go back to a gold standard. We'll see.
Mm-hmm. To your point that we were discussing about the way that these big hedge funds and institutions like that move, I was having another conversation earlier this week, and he was making the point that it's like moving a freighter, right? It is a slow moving vehicle, but once it decides to turn, boy, does it, right?
Well, you're talking the Fed now, right?
No, the institutional investors that are starting to notice gold and commodities performance.
Yeah. No, and right now, if you took cautionary steps, let's say 3 or 4 months ago, like started to divest yourself of certain high tech sectors, for example, in stocks, and move that money somewhere else. Mm-hmm. You certainly didn't move it into T-bonds. You'd have been skewered, okay? There's only one category that worked. Gold has gone up a couple $100 mm-hmm. since late last year. Gold miners have gone up, $12 from 28 to 40. They've been rewarded by buying things like Newmont. Look at a Newmont chart sometime. It's gone off the page. It took out the 2020 high. It's a blue chip gold miner. That's what big asset managers buy. Yep. It's reflective of their decision to switch. And they've been rewarded for that. Why should they change? the Fed threats have not stopped the correctness of that decision to buy gold related. Mm-hmm. So they have plugs in their ears when it comes to the Fed now, I think.
And again, now speaking about the Fed, it seems that their effort to control inflation seems more like a pull than a push to actually be able to cause the inflation come down in markets that they really don't have control over by raising the interest rates, right?
Yeah, and they seem to think that they can do that. But if this were a 4 or 5 year old bull market in commodities, I'd say, yeah, maybe this time it'll work. Mm-hmm. This is a fresh bull market by our metrics. And even prices we showed on the Bloomberg, it's 130 right now. Heck, it was 240 back, a decade ago, two ago. So, it's not like it's off the page. Yeah, this year-over-year measurement stuff is ridiculous. Commodity price, the CPIs. Last year was depressed, so it's easy to get a doubling. Okay, but when you look at the long-term prices of the Bloomberg Commodity Index, for example, it's not off the page. Mm-hmm. It's these false year-over-year comparisons. Go back a decade, and you'll see it's not overpriced yet. It just woke up.
Mm-hmm. Yeah, I think that's a really interesting and important point, is that the inflation that we're seeing now is comparative to last year, right? Mm-hmm. When and we were just basically coming out of lockdowns and stuff like that at that point, and things were just starting to heat back up.
Yeah, correct, and therefore the metric is meaningless, effectively.
Mm-hmm. Well, in possibly more ways than one, right?
Yeah, that's correct. Yeah. Anyway, we're facing interest. I've been in these markets for 50 years. I got in the futures business in 1975 with E.F. Hutton when they founded. The chairman at the COMEX was head of Hutton's commodity division. Gold had just been legalized that year. So I've been around, almost 50. And I don't think I've ever seen the juxtaposition of markets where they are now in terms of what their likely outcome is going to be, in terms of dynamics, including in terms of global impact. We're facing something we've never seen before. So don't expect gold, for example, to just have another routine 7 to 8 fold bull market. We're in abnormal times.
Mm-hmm. So, Michael, can I ask you a little bit about, what the attitude was like towards gold back when it was legalized? Did you know a lot about it? What's that?
It was a bull market peak. In fact, we call the top in Bitcoin when it first became legalized, became a futures contract on the CME in December 2017. It had just done what gold did between 1972 and 1975. It gone parabolic 7 to 8 fold. Mm-hmm. Gold was at $200 an ounce when it commenced trading in January of 1975. That was a bull market peak, a blow off top. And sure enough, it corrected 50% by August of 1976 down to 103.50, almost 50% drop. Mm-hmm. And so gold back then was at a technical peak, mm-hmm. and it collapsed. And then it turned around and went up 8-fold again by 1980.
Right.
$850 from 103. Mm-hmm. Okay. So we're not at that kind of situation now.
Mm-hmm. But what was your actual attitude towards gold? Like, were you educated about it? Did anybody had anybody taught you the importance of it? How did you view it back then?
Oh, I joined Hutton. I was going to get a PhD in political philosophy, and I quit after doing my coursework because I knew I wasn't going to get tenured or anything like that. Mm-hmm. And I was a libertarian, and you wouldn't get a university job back in the mid 1970s doing that. Mm-hmm. And a friend of mine had joined Merrill Lynch and said, "Come on in, the water's fine," commodity division. And so I joined Hutton. I got lucky enough to get hired by the headquarters office, and I knew about gold fundamentally, but not technically. Mm-hmm. So no, I did not anticipate that was the top. No, mm-hmm. No way. Later on, our calls were quite good on gold. We founded MSA in 1992. I got out of the brokerage side and got into research. Okay, mm-hmm. And all of our calls on gold have been accurate. Major tops, major bottoms. So we still maintain a bullish view, but we're not anywhere near like that situation. And back then, no, I did not know technicals. Mm-hmm. I first started to learn how to do price charts because my boss, David Johnston, was a price chart technician. But then I later adapted to using momentum. Plotting charts by hand back then. This is prior to Excel. Okay. And I caught the 87 crash based on quarterly momentum of the S&P. And after that, I smacked myself in the face and said, I need to get into research and sell it and get out of brokerage using momentum as the tool. Because again, generally momentum anticipates events before the price chart tells you the same thing. And right now, everything I've said today is based on emphasis on the momentum analysis of those markets.
Mm-hmm. Yeah, absolutely. And of course, I want to thank you for being so generous with all of your charts and your knowledge many times on this program and just in general for our audience to, help point some things out for all of us.
Thank you, Tom. It's always a pleasure.
Absolutely. Of course, your website, olivermsa.com, and on Twitter, Oliver_MSA. Michael, thanks so much for your time today.
Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.